Got it. And so if you mentioned, okay, so if you mentioned it's been around for a long time, why hadn't I heard about it? How does it work? Like, are you doing are you is this really that new? Like, are you I mean, is it really that old? Like, are you doing how it worked originally, or do you have some improved version of what you do?
Yeah. So one reason it is rarely heard of is because according to Canadians investing government investing regulations, not everybody is qualified to invest in this kind of business or in this kind of strategy. So in order to be able to participate, you got to be considered as accredited investors. And there are a few criteria you can meet either one of them. For example, if you got a financial assets with a net amount before tax above 1 million, you're a accredited investor. If for the last couple of years, you've been having a net income exceeding 200 grand 2 years in a row, then you're a credit investor. Or if you have a family income like a 300 grand in the most two recent years, you are considered a credit investor. There were a few things like that. So that filters out majority of the people. We know Canada, most of the time you don't earn that much, right? So that's one reason. And another reason is at the beginning, there were people who tried this strategy. The original strategy, which was founded in 1954, was pretty popular back in the 90s. However, there are significant risks associated with the original, how to say, like with the original method. And that causes people to eventually lose money. They actually, yeah, despite they save quite a lot of tax, in the end, when you add things up, they lose money. And that's why if you started Google, going to Reddit, and you might see some people complaining or warning about this strategy.
Well, so
So
now how does the why don't you tell us like how does the original model works, and then I guess that will flesh out the risk of the original model, right? And then I'm guessing like you're not really doing the original model, you're doing an improved model, right?
yes,
Okay.
so let's see for the original model or original flow through shares, we as an investor will purchase shares from those mining companies at about 8 to 12% higher than their public trading price. We got to give them some discount. Otherwise, nobody is sharing, how to say, like selling you at the original price. So you're paying a little bit more. And you're entitled to tax deduction depending where you are at both federal and provincial level. Certain provinces give you a provincial tax deduction as well. And that's a big chunk of money you're going to get by the end of the year or the tax season. And what the problem is, when you buy those shares at the like 10% or so higher, you can't trade it right away. According to the agreement you sign, you got to keep that shares 4 months to 2 years, depending on how long it is. And to hold a small company stock like that is very risky, especially as mining company. Any news, the mining price fluctuation or their exploration result can cause the company's, I say, like stock price fluctuate. So in the end, you might have like 40, 50% of, how to say you put in 100 grand, you bought this flow through shares. And by the end of the year, your tax deduction is 52 grand. But the stock might go to zero or go down like 90%. So in that case, you can lose money, plus all the credit and stuff like that. You may make money, but there's always a chance you lose money because of the stock market fluctuation,
Uh,
right?
uh,
Yeah.
okay, so let me sum it up. Let me sum it up. What you're telling me is that there are two major risks for the original flow through shares model. Number one is it sounds like liquidity, so you're holding it for a long time. Number two is that you're buying at a premium, and these stock prices can fluctuate so bad that if it tanks, even if you get back a significant tax reduction right off, the stocks you're holding are worth zero. So essentially, you just lost more money than you would have got back from the government.
Yes,
Yeah,
it's a
that's
possibility.
pretty high risk. Yeah. Okay, got it.
Yeah, and I know you, with your channel, you don't like money to
I
be
do
held,
not like high risk, high
right?
reward.
So
I like
yeah, exactly.
low risk, high reward. So
Yeah, and also high turnover rate money,
that's
half
right.
a year or so, or a few months. Yeah, you like that one.
Three key things I look for. High liquidity, so you only
Yeah,
hold it for a short term, and then low risk. So once you understand it, the risks are really low, and then high reward, like returns at minimum
yeah,
like 20-30% plus. Yeah. So
yeah.
where does that lead us to?
Oh, well, that leads us together doing this interview together. Otherwise, we
Yeah,
might do other stuff.
exactly.
So
Yeah.
yeah. So if you want, you can show some example slides, and I can, tell people exactly how the calculation works.
Right.
Uh, yeah,
Right. Right.
numbers make sense, right?